Ever wondered how some people seem to effortlessly build wealth while others struggle just to make ends meet? It's not magic, it's not luck, it's investing. But the world of investing can seem intimidating, especially if you're just starting out. Where do you even begin? What if you don't have thousands of dollars to invest? Don't worry, I've got you covered. In this video, I'm breaking down the fundamentals of investing specifically designed for beginners. We'll demystify the jargon, explore different investment options, and most importantly, I'll show you how to get started even if you're only working with a few bucks. That's right, you don't need to be rolling in dough to start growing your money. Stick around because I'm going to share a simple, easy-to-understand investment strategy that anyone can use. So, hit that like button, smash that subscribe button, and let's unlock the power of investing together. Before we dive into the how-to of investing, let's first answer a fundamental question. Why is investing so important in the first place? Saving is important, but it's only half the equation. If your money just sits in a savings account, it's not growing. Inflation can erode your savings over time. Investing helps your money grow and outpace inflation. It's time to stop letting your money sleep and start putting it to work. Now that you understand the power of investing, let's explore the different types of investments you can choose from. Think of this as your investment menu, each option with its own flavor profile and risk level. First up, we have the star of the show stocks. Stocks represent fractional ownership in a company. When you buy a stock, you're essentially buying a tiny piece of that company. If the company performs well, its stock price goes up, and you make money. Conversely, if the company struggles, the stock price may go down. Stocks are considered a higher risk investment, but they also offer the potential for higher returns. Next, we have the reliable and steady bonds. Bonds are like loans you give to governments or corporations. When you buy a bond, you're lending money for a fixed period of time at a predetermined interest rate. Bonds are generally considered lower risk than stocks, but they also offer lower potential returns. Now let's step off the beaten path and explore real estate. Real estate involves buying, owning, and selling physical properties like houses, apartments, or commercial buildings. It can provide rental income and potential appreciation in value. However, real estate requires significant capital and comes with responsibilities like property management. Moving on to a more hands-off approach, we have index funds and mutual funds. These are like investment baskets that hold a diversified portfolio of stocks, bonds, or other assets. They offer instant diversification and are managed by professionals, making them suitable for beginners. For those seeking alternative investments, there's the world of commodities, precious metals, and cryptocurrencies. Commodities include raw materials like oil, gold, or coffee. Precious metals like gold and silver have been a store of value for centuries. And cryptocurrencies like Bitcoin are digital currencies that operate independently of central banks. However, be cautious with these as they can be highly volatile. Remember, each investment type has its own risk and reward profile. Diversifying your portfolio across different asset classes is crucial to mitigate risk and maximize potential returns. Ready to start investing? I've got a step-by-step roadmap to guide you, even if you're starting from scratch. Step 1. Define your why. Before you even think about what to invest in, you need to determine why you're investing in the first place. What are your financial goals? Are you saving for retirement? Do you want to buy a house? Are you dreaming of early financial freedom? Having clear financial goals will not only motivate you, but also help you determine your investment timeline and risk tolerance. Step 2. Assess your financial situation. Take a close look at your income, expenses, debts, and savings. Investing should be done with money you don't need for immediate expenses or emergencies. Remember, investing is a marathon, not a sprint. Step 3. Choose your investment account. You have several options here. You can open a traditional brokerage account, a Roth IRA for tax-free retirement savings, or a 401k if offered by your employer. Research the benefits and limitations of each account type to determine the best fit for your needs. Step 4. Time to pick your investments. Remember that diversified investment menu we talked about? Now it's time to select your dishes. Consider your risk tolerance, investment timeline, and financial goals. If you're just starting out, index funds or ETFs are a great option as they offer instant diversification and are managed by professionals. Step 5. Automate your investments. One of the best ways to ensure consistent investing is to automate the process. Set up automatic transfers from your checking account to your investment account each month. Treat it like a non-negotiable bill payment. Step 6. Monitor and adjust. Investing is not a set-it-and-forget-it endeavor. It's essential to regularly monitor your investments, track their performance, and make adjustments as needed. Rebalance your portfolio periodically to ensure you're still aligned with your risk tolerance and financial goals. Chapter 4. Investing Pitfalls. Don't fall for these common traps. Even the savviest investors make mistakes, especially when starting out. Let's shed light on some common investing pitfalls to help you avoid costly errors. First up, emotional investing. We've all been there, letting our emotions dictate our investment decisions. Fear and greed can be powerful motivators, often leading to impulsive buying or selling at the worst possible times. Remember, successful investing requires a rational and disciplined approach. Next, beware of the hot tip temptation. We've all heard stories of people striking it rich by following a hot stock tip. But remember, for every success story, there are countless others who lost money chasing speculative investments. Don't base your investment decisions on rumors or hearsay. Stick to your investment plan and rely on thorough research. Another common pitfall: lack of diversification. Remember that diversified investment menu? It's not just about variety, it's about managing risk. Putting all your eggs in one basket, even if it's a seemingly promising basket, can be detrimental if that investment goes south. Spread your investments across different asset classes to mitigate risk. Timing the market sounds tempting, right? Buying low and selling high is the holy grail of investing, but it's much harder than it sounds. Even seasoned professionals struggle to consistently time the market correctly. Instead of trying to predict market swings, focus on time in the market. Invest consistently over the long term, and you'll be well positioned to ride out any short-term market fluctuations. Lastly, neglecting fees and expenses. It's easy to overlook the impact of fees on your investment returns. Remember, every dollar you pay in fees is a dollar less working for you. Be mindful of expense ratios, trading commissions, and other hidden costs associated with your investments. Chapter 5. Level up your investing game. Pro tips for maximizing returns. Ready to take your investing to the next level? Here are some pro tips to help you make smarter investment decisions and maximize your returns. First and foremost, harness the power of compound growth. Compounding is like earning interest on your interest. The earlier you start investing, the more time your money has to compound and grow exponentially. Even small amounts invested consistently over time can lead to significant wealth accumulation. Next, embrace a long-term perspective. Investing is a marathon, not a sprint. Don't get caught up in short-term market fluctuations or try to time the market. Stay focused on your long-term goals and remember that patience is key. Diversify, diversify, diversify. I can't emphasize this enough. Diversification is essential for managing risk and maximizing your potential returns. Don't put all your eggs in one basket. Spread your investments across different asset classes, industries, and geographical regions. Consider tax-advantaged accounts. Make the most of tax-advantaged accounts like Roth IRAs and 401(k)s. These accounts offer tax benefits that can significantly boost your investment returns over time. Consult with a financial advisor to determine the best options for your situation. Stay informed and educated. The world of investing is constantly evolving. Make it a habit to stay informed about market trends, economic indicators, and new investment opportunities. Read books, listen to podcasts, and follow reputable financial news sources. Remember, investing is a journey, not a destination. Continuously learn, adapt, and refine your investment strategy as your financial situation and goals evolve. Chapter 6. Start your investing journey today. And there you have it. We've covered the fundamentals of investing, demystified the jargon, explored different investment options, and equipped you with a step-by-step roadmap to get started. Remember, investing is not just for the wealthy or financially savvy, it's for anyone who wants to take control of their financial future and build long-term wealth. The most important step is to simply start. Don't let fear or procrastination hold you back. Time is your greatest asset when it comes to investing. The earlier you start, the more time your money has to grow and compound. Remember, investing is a journey, and it's okay to start small. Even if you can only invest a few dollars each month, it's a step in the right direction. As you learn and gain confidence, you can gradually increase your investment amounts. Congratulations! You're now equipped with the knowledge and tools to embark on your investing journey. Remember, the key is to start small, stay consistent, and never stop learning. Your future self will thank you. Don't forget to like and subscribe for more videos on personal finance, investing, and building wealth. Now I want to hear from you. What's your first investment going to be? Let me know in the comments below. I'm excited to see what you achieve.